Tristram LEACH, co-head of European Credit at Apollo. Thanks so much for joining me here at the IPEM TV studio. Lots of people here, lots of conversations going on, but it seems to me that credit is the big one, and you're the person I should be speaking to, so thanks a lot. Give me just a sense before we get into the kind of conversations about the Apollo credit business, the depth and the breadth.
So I think it's underappreciated really how big Apollo's credit business is and just how broad it is. So 400 billion of the 600 billion AUM we have at Apollo is in the credit business. Much of that is in investment grade credit, which we're taking onto our own insurance balance sheets. We're able to really act as a kind of one-stop shop to corporates, given we have an enormous range of cost of capital, from investment grade through to sub-investment grade, sponsor lending, etc. So really across corporate credit and asset-backed credit, investment grade and sub-investment grade, we feel like we've covered an enormous amount of the waterfront rather, and you know it remains a huge growth area for us, and really where the centre of gravity is at the firm.
Well, let's talk about that waterfront, because there is a lot going on in credit. Where do you see right now the most sort of activity, the most action? Where are things starting to pop up that are interesting to Apollo?
So look, if you look at the sub-investment grade space, the sponsor lending space, last year was interesting because the syndicated markets were closed, and it was really a time when private capital, private credit, especially in the larger ticket space, really proved its value. It was the way to fund M&A last year, and I think that's going to roll through. We're going to see it continuing to take share from the syndicated markets. You know, it's proved itself as a viable alternative for funding sponsor M&A. The other area, and I already touched on this, that we're seeing a lot of opportunity is in, you know, investment grade privates. It's an area we have massive natural demand for because of our insurance balance sheets. You've seen us active in these kind of transactions in Europe, the deal we did for Vonovia earlier this year, transaction for Air France, where we're able to access investment grade credit product in a way that works very, very well for the borrower and is attractive to the borrower. And as I mentioned, is exactly the kind of product we need internally as well. So I think that's probably going to continue to be a growth area. I think you're going to find that we're able to continue to partner with corporates as well as sponsors, and that both are likely to be avenues of growth for us.
So when you're looking ahead into this market, I mean, you know, I completely hear what you're saying about the partnership with corporates that you're doing. You named a few. Are you seeing ahead a particular maturity wall of refinancing coming up? Are you sort of having early conversations? You know, what are you sort of planning ahead for sort of 12, 18 months? Where do you see rates? Where do you see the sort of macro?
Yeah, so you touched on maturity wall, and that's really interesting. Both investment grade and high yield markets have pretty short maturities in Europe at the moment. If you think about the last 5-10 years, everyone was funding in ultra low rates. And especially in the fixed rate market, you've locked in those low rates. Why refinance early? So at the moment, the maturity of the European high yield market is at 3.5 years. That's very short versus historical standards. It's much shorter than, for example, its counterpart in the US. And it means that really there's a lot of companies that need to refinance in pretty short order over the next couple of years. So there's a lot of supply going to be coming. And the way companies are going to look to address those capital structures is going to really, you know, look at the breadth of our products that we can offer. So, you know, obviously we have a public markets business that can be helpful there, but also we can address these capital structures with private loans, etc. So certainly we think there's supply coming. There's a maturity wall in front of us that's moving closer, and an unusually short maturity in the fixed rate markets. There's probably been a sense that corporate treasurers have been waiting for rates to fall. As a bit more of a consensus emerges around rates being a little bit higher for a little bit longer, I think people are going to start pulling the trigger, and the time is kind of now.
Tristram, let's just get into the sort of weeds a little bit about what we're seeing within the credit market. CLOs, what exactly is going on there at the moment? And maybe there's some differences that we're seeing between the US and Europe, for example, and the sort of demand that's coming through.
Yeah. So obviously, CLOs are an enormous driver of demand for syndicated loan product. And there's an interesting distinction between what's happening on either side of the Atlantic. In Europe, there's still quite good CLO creation, people setting up warehouses, trying to buy inventory ahead of printing CLOs. That means that there's a real tailwind to syndicated loan demand, very strong technical in that market. In the US, you have a higher proportion of CLOs that have moved out of their reinvestment periods, and therefore you're losing a bit of the natural bid for syndicated loans. So there's a little bit more selectivity going on in terms of syndicated loan demand in the US, particularly driven because the CLO market is a bit less robust there than what we're seeing in Europe.
And let's just take a sort of a step back again and go back to the sort of higher level macro. I mean, are you sort of looking ahead now at going, rates aren't necessarily high, we're back to a kind of a normal level where rates are going to stay now and everything sort of gets planned from here roughly around this level? Or is there...
Yeah, look, I think we think rates need to stay higher for longer. I don't think that's a particularly controversial call these days, but inflation's proving pretty sticky, especially in Europe. Inflation's stopped falling. So the idea that we just go back to normal of ultra-low rates wasn't normal, it was exceptional. Inflation has come back, rates are going to have to stay higher. Corporate treasurers, companies, sponsors are going to have to get used to higher all-in cost of funding. That's great for those of us in the debt market. All-in returns to credit are very, very attractive. As I think, people from across the industry and certainly from Apollo have been consistent in saying. But yeah, we think this is the new normal in terms of cost of debt. It's going to potentially lead to the need for less levered capital structures, but it certainly means that debt as a risk reward proposition seems very, very attractive as an investor.
And it's an interesting time, I think, for managers, really. There has been this wave of money into alternatives, generally speaking. And I feel that now we're going to see the first time a little bit of alpha versus beta coming through. Do you think that there's it's not that the industry is necessarily worried, but it feels like that's the dynamic, this alpha versus beta.
I'd certainly agree, and we're pretty excited for it. When the product you're selling is your management expertise and your underwriting expertise, having a period where that expertise is going to be tested is actually quite an invigorating thought. There have been essentially no defaults for the past 10 years, maybe 15, post-crisis. Having an environment where there's going to be some dispersion in outcomes, you're going to see some companies default. You're then also likely to see some dispersion in manager performance. And when you have the confidence we have in the way we've set up our business, in the rigor of our underwriting, as I say, that's invigorating. We're going to be able to show our value add and demonstrate a little bit of alpha, as you say.
Yeah. Well, Tristram, thanks so much for talking to us. Really appreciate you taking the time, and I'm sure I'll be seeing a lot more about your work in the news headlines in the months to come.
Let's hope so. Thank you so much.